to crypto companies. And banks are also free to conduct crypto activities as long as they do so in a way that is, protective of safety and soundness.
Thank you very much. Let me shift gears because I want to give you just on the housing sector once again, but give you a little freedom here to speak to that area. You correctly are trying to balance inflation and price stability, but also higher rates have a significant impact on the housing market as shelter and housing costs are a significant driver of why many families can't afford the things that they need. Can you provide color as to how you're analyzing the impact that housing and shelter costs have on families and on inflation with your desire to maintain price stability, the interest rates that is currently set by the Fed?
Sure. So, we realize that people are feeling high housing costs and high financing costs. In terms of inflation, we look at something called owner's equivalent rent and rentals, and that's meant to capture both rented housing and owned housing. And it's been very sticky. It's been one of the stickiest parts of inflation. I'm happy to say now it actually is coming down quite regularly. That's very good news. That's been the part, really, it's been the service inflation that's been stickier than other parts of inflation. So that's good news for people, I think, and it is showing through into measured inflation now. Again, in the long run, the best thing we can do is restore price stability and let the market work. Even then, though, we're still going to have a housing shortage.
What data do you think is leading to the reduction in the rent equivalent?
I just think it took time. So the thought is when you would think that if rents come up every year, you would think it would take 1 year or 2 years for a lack of growth in rents to show up in a lack of growth in housing prices. It turns out it takes 4 years or 3 years. If you're an existing tenant, it's a complicated thought, but if you're an existing tenant, you don't actually catch up the way you would if new tenants came in. And so that's made the measurement of inflation stickier. But I'm happy to say we've been through that period now, and we are really seeing now housing services inflation pretty close to where it was when inflation was solidly at 2%.
Thank you. I yield back.
Gentleman yields back. Gentleman from California, Mr. Liccardo, is recognized for 5 minutes.
Thank you, Mr. Chair. Chairman, thank you for your testimony today. I appreciate that your dual mandate is full employment and price stability, and I appreciate your efforts on behalf of our country to achieve those. My understanding is that critical data is collected by the Bureau of Labor Statistics to help formulate the indicators that you rely on, that we rely on to understand unemployment rates, CPI, and other inflation indicators. We are certainly hearing a lot about the impacts of DOGE on our workforce, and specifically about the elimination of many of those positions in BLS. And now we have a proposal in front of Congress to cut $56 million from that agency. Are you concerned about the ability of your team to get accurate data and about the ability to have reliable indicators to make good decisions upon?
I wouldn't say that I'm concerned about the data today, although clearly there has been a very mild degradation of the scope of the surveys and things like that. But I would say the direction of travel is something I'm concerned about, and that is measuring the U.S. economy carefully and well is a project that's been going on, and we're getting better at it for 100 years and more. And it's really important, not just for the Fed, but for Congress and for businesses, frankly, to know what really is going on in the economy. What's happening? Is growth high? Is it low? And all those sorts of things. So I think it's a smart investment to just continually try to get better at measurement of what's happening in the economy. And I don't like to see that, the kind of stories I'm reading and the idea being that the data is going to become more volatile and less reliable. That'll make it more difficult for the private sector and for you and for us. And I don't like to see that direction.
I agree. Thank you. I appreciate that it's not your role to comment on the advisability of specific policies, but given your critical role in ensuring price stability and reducing inflation, I have had conversations with, quite recently, just a week ago, with a C-suite executive of a major global retailer who informed me, because I asked, why aren't we seeing the impact of these tariffs and price data yet? And he said, it's coming in the third quarter because it takes time for tariffs to work their way through distribution chain. Often what you have on the shelf today may have been imported 2 or 3 months ago. Is that your understanding? Do you anticipate there may be impacts down the road?
Yeah, that's very much what I hear. I happened to meet with an unusually large number of business people in this last FOMC cycle, and that's a typical thing that they'll say, especially the retailers, that what's being sold now was an inventory in February, let's say, and it just isn't showing up yet. So we do expect to show up, tariff inflation to show up more, but I want to be honest, we really don't know how much of that's going to be passed through to the consumers. We just don't know, and we won't know until we see it. It could be lower than we expect. It could be higher. We have to wait and see, which is kind of what we're doing.
I appreciate the uncertainty. Another thing he told me that had me very concerned was that often they will increase prices on goods not subjected to tariffs to compensate for the very substantial losses they have to suffer with the increase of tariffs on relatively price elastic goods. So in other words, necessities will also tend to bear a higher price, even if they're not subjected to tariffs. Is that your understanding of the potential impacts?
You know, that very much is something that companies will tell you that they do. If they can't cover the losses on the thing that's being tariffed, they'll find other ways to do it. We actually don't have prominent examples of that yet, but that's certainly a possibility. And that did happen in the last tariff episode with washing machines and dryers.
Thank you, Mr. Chairman. And finally, there's indications in the introduction of the report that the Fed is losing its ability as we see interest rates getting closer and closer to the minimum threshold, the ability to stimulate this economy in times of recession. We haven't had a recession, or at least we haven't had an extended recession in a decade and a half. I am particularly concerned now as we are looking at debt that is being considered to be imposed on future generations by this particular bill. Could there be a combination of very high debt and very little room to move in monetary policy that could undermine our ability to respond to the next recession?
So we faced that issue quite a bit in the era of very low interest rates, but we're at higher levels of interest rates now, so there's significantly more room to cut than there was then.
Thank you.
Gentleman yields back. Gentleman from Wisconsin, Mr. Fitzgerald, you're recognized for 5 minutes.
Thank you, Chairman. Chairman Powell, thanks for being here today. Appreciate it. I want to go back to something we had some brief discussions about this in the past, but in September of 2024, with core inflation still being above target and the labor market was holding steady at the time, the Fed made a decision to cut rates by a full 0.5 percentage point. It kind of raised some serious questions as to whether or not the data truly supported such a move at that time. And I think some of us were surprised that it was a full 0.5%. So can you revisit that again, what the Fed was thinking at that time? Because it seems to be somewhat of an enigma now. It stands out as, why was this done? Why was the 0.5% done at that point?
I'd be glad to. So, first of all, the inflation and employment readings were very similar then to what they are now. They weren't terribly
True.
a tenth or two.
Right.
But the difference then was, you mentioned that the labor market was stable. It wasn't. The unemployment rate had actually gone up almost a full percentage point. I was very clear about this. We were very clear about it in real time too. The concern at that time was that there really hasn't been an experience, or hadn't been an experience in the modern era, in which the unemployment rate has gone up close to 1%, that hasn't been followed by much higher levels of unemployment and a recession. So we were looking at that and saying, and remember, at the point we're talking about, the federal funds rate was 5.3%, so definitely a very restrictive level. We were the last of the big central banks to cut. So we wanted to make a statement that we were supportive of the labor market and not just inflation. We've been focusing on inflation. I was quite clear about this. So that it was all about the labor market. Inflation was the same, and unemployment was roughly the same, but it was the rate of change with the unemployment rate that raised a lot of concerns. And remember, we were being criticized for being late to cut. So we could have done 25. If we'd done 25 in July, we were criticized for not cutting in July. Instead, we cut 50 in September. And it seemed like the right thing to do. And at the end of the day, we do what we think is the right thing when we think it's the right thing to do. We don't take into consideration political factors. If we start doing that, I don't know where that stops. Once you start considering elections and stuff like that, where does it stop? So
And I didn't want to insinuate that it had anything to do with the election itself, but there just seems to be some very similar numbers right now. And I'm wondering, and I don't bring this up because I want to kind of make a point about did the Fed do the right thing or not? I bring it up because it seems like everything's in place right now to kind of do the same thing, make the same move. I know this morning already, you've talked a little bit about where you were on inflation right now and kind of what you're watching, but is there any lesson there? I mean, are we in a position where it would be appropriate to do something as big as a 0.5% cut again?
Well, look, as I said, if you just look at the basic data and don't look at the forecast, you would say that we would have continued cutting. The difference, of course, is at this time, all forecasters are expecting pretty soon that some significant inflation will show up from tariffs. Now, and we can't just ignore that, but we're just saying let's wait and see more. That's all we're doing. And if you will have noticed, a substantial majority of the committee has written down rate cuts in the remaining 4 meetings this year. So it's just a question of being prudent and careful. But at a time when the labor market is still strong, we don't see weakness in the labor market. If we did, that would change things. We're going to continue to adapt as the data adapt. But that is the difference between then and now. Then inflation was forecasted to continue to come down. Here it's forecasted to go up by all forecasters. So, and again, we're not overreacting to that. We're just saying, hey, as long as the economy's strong, we can take a little bit of a pause here. And that's what we're doing. And again, continue to adapt as the data comes in. If we see data that suggests that inflation's not going to produce big increases, that would matter. And if we saw the labor market weakening, that would matter too. But we don't see those things.
What about supply chain? In 2020, that was a big issue, obviously related to COVID. But I know myself and other members, when we're in our districts and we're specifically talking to light manufacturing, there's concerns about the supply chain. Is that part of the data package that you review when you make a decision about where we're headed in the future?
Very much so. I think that's one of the great, won't call it a great thing, but one of the lessons to be taken from the last episode is supply chains really matter. We're watching that carefully. It's too soon to say really on that. We're not seeing it yet, but
Gentleman's time has expired.
Thank you, Chairman. Yield back.
Thank you, Mr. Fisher. The gentleman from New Jersey, Scott Heimer, you're recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, as a member of the Intelligence Committee, I'm deeply concerned about the threat of Iranian cyber attacks on our financial system as retaliation for our strikes on their nuclear facilities. In its cybersecurity report last year, the Fed acknowledged that critical infrastructure, including financial services, is at risk with rising geopolitical tensions. Iran has a history of targeting American infrastructure companies and financial institutions and banks, which could obviously threaten and cause economic damage. What actions is the Fed taking now to monitor and defend against Iranian or proxy cyber threats targeting our country's financial institutions?
So we're in touch with the other regulators and the parts of the government that work on cyber, as you know, and we're in touch with the banks to say, for people to be on the alert for things like that to happen, and also we're on the alert because we're a target as well. So you're right to raise it. It's a big issue, and
you feel like you have the resources right now to be prepared for that?
Yes, I mean I think we do. We spend a lot, and the government generally spends a lot on these things, and but you can never ever be comfortable in this area because the bad guys are always getting better. So we need to get better.
Thank you, Chairman. Switching gears, the president and members of his administration have recently called you out, various name calling for certain decisions you've made. I know that some people worry that the president's bullying will impact your decision making. I know you work together, and I know that and respect obviously your independence greatly. Anything you want to add and give you a chance to reiterate your independence to the American people?
Yeah, I would just say we're focused on one thing, and that is we want to deliver a good economy for the benefit of the American people. That's it. And anything else is kind of a distraction. I don't mean to refer to any particular thing, but we stay focused on that task all the time. We always do what we think is the right thing to do. And, we live with the consequences. And I don't know how else to do the job.
Right, so the name calling and the Mr. Too Late and all that stuff, the American people shouldn't worry about that. You're focused on being independent.
That's what I care about. I care about doing the job for the American people. The things we do matter a lot for people's lives, and that really concentrates the mind. You want to just stay focused on that task. As long as you're sitting in these chairs that we occupy, focus on that task, do what you think is the right thing, and take the consequences.
Thank you, Mr. Chairman. You've previously stated that you view stablecoins as a form of money. Payment stablecoins are already being used for both retail and wholesale payments, as well as for settlement. Recently, this committee passed the Stablecoin Act and the Senate passed the Genius Act, both aiming to establish clear regulatory frameworks for fully reserved dollar-backed payment stablecoins. Given their design to maintain a stable value and be redeemable for U.S. dollars, should the SEC or other regulators explore treating these stablecoins as cash equivalents for accounting or financial reporting purposes?
So let me say, I think it's a great thing that bills are moving. We need a stablecoin framework on that particular issue. I don't have a view for you. I can come back to you on that.
I'd be grateful. Thank you. The high rates have also caused, as we've discussed, the cost of paying off our nation's debt to skyrocket. The CBO estimates that interest payments will cost the U.S. $1 trillion in fiscal year 2026 and continue to rise to almost $1.8 trillion by FY 2035. How do you see us continuing to be able to afford to pay off our debt at this rate? And as the U.S. continues to borrow, how does that impact your decision to keep or cut rates? Obviously, foreign countries like Japan, who are significant buyers of our bonds, have started decreasing their purchases significantly. Other internal pressures worldwide are having that impact. Are you worried about this global issue?
Fiscal policy and it really is not our job, and it's not something we take into consideration in making monetary policy. That's really elected people's jobs. And I would add that, for some time now, the U.S. federal fiscal policy has been on an unsustainable path, and I'll limit myself to that.
Last question. Last week, you chose to keep rates steady, and families in our state, as you'll hear from a lot of people today, are really struggling with the higher cost of borrowing and putting off bigger purchases on things like cars and homes. As a result, their wallets being crushed by these price hikes and obviously the president's tariffs. What do you have to say to Jersey families who are struggling with higher costs, and how you look at how they should forecast themselves for their own families?
We're committed to returning inflation sustainably to 2% and keeping it there in the long run. And what we're doing now is we had cut rates by 100 basis points, so they've come down quite a bit. And when the time is right, I expect that will continue, and that will depend on economic factors, in the coming months for starters.
Thank you. I yield back. Thank you, sir.
Gentleman yields back. Gentleman from Nebraska, the chair of our Housing and Insurance Subcommittee, Mr. Flood, you're recognized 4 or 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, later this week, the banking agencies will be proposing changes to the supplementary leverage ratio, which we think are long overdue, considering the Fed in 2021 indicated that they would soon put out proposals for reform to the SLR and never actually did. However, our understanding is that the proposal being considered this week will not allow for treasuries to be excluded from the SLR calculation. Secretary Bessent earlier this year had argued that such a change could serve as a boost for banks and their ability to intermediate in the treasury market and could potentially pull treasury yields down 30 to 70 basis points. Chairman Powell, do you agree with the Treasury Secretary's comments on the potential positive impact of SLR reform on the treasury market? And what is the rationale for not excluding treasuries from the SLR calculation in the proposed rule?
So I agree that when the leverage ratio is binding, it discourages banks from undertaking low margin, fairly safe activities such as mediation in the treasury markets. So this should encourage more mediation. I don't have a numerical estimate of how much that would matter, but I do think it would matter. I think it was important. I've supported leverage ratio reform for a very long time, since before 2021. In terms of the structure of the thing, I think we're seeking comment on a particular proposal that doesn't involve exclusion, but we're also asking a question about exclusion.
Mr. Chairman, considering the Fed temporarily excluded treasuries from the SLR calculation during the COVID pandemic, Were you aware of any safety and soundness or financial stability problems that arose as a result of that decision? And if not, why was that relief terminated in 2021?
So that was an emergency measure. From the beginning and end, it was an emergency measure. I think, my long-held view is that we should have a permanent measure, and now we're going to. And we have an open board meeting on Wednesday afternoon, and after I finish my hearing on the Senate side, and I'm very much looking forward to putting this proposal out for comment.
Thank you. In March, the Federal Reserve, together with the FDIC and the OCC, announced that they intend to issue a notice of proposed rulemaking to repeal the 2023 Community Reinvestment Act and replace it with the legacy CRA framework. Nearly 3 months have passed since this announcement. What is the status of this project?
Well, we're going to do what we said we were going to do. It's just a question of execution, and I think you'll see that coming. This would be so Vice Chair Bowman has the job of sequencing these things, and that one's certainly coming.
Do you intend to issue a proposal that will be a clean rescission and replacement of that rulemaking, or are you considering amendments to the legacy rule?
I honestly don't know. We'll come back to you on that.
Okay, so we should know more later this week.
We might, yeah.
Okay. Finally, I'd like to build off of what Congressman Stile asked previously on the supervision of novel activities program. Do you feel any changes could be made to it to encourage innovation, and do you anticipate any such changes to the program?
I do, and I also think Governor Bowman, now Vice Chair Bowman, is someone who is actually deeply knowledgeable and experienced in supervision, and that hasn't really been the model. We've more had people who are experts on regulation. I think she brings a particular ability to move supervision in a healthy direction while also preserving safety and soundness. And that's what you mentioned is one of the dimensions in which I think that will be true.
Thank you for your testimony today. I appreciate your service to the country. And with that, I yield back, Mr. Chairman.
Thank you.
Gentleman yields back. The chair recognizes the ranking member of our full committee, Mrs. Waters, for 5 minutes.
Thank you very much, Mr. Chairman. Chair Powell, I appreciate that despite the repeated attacks by the president and his cabinet on you personally, that you stood your ground and you did not bow to pressure from Trump, especially given the current state of economic uncertainty due to his policies. Last week, the Fed held interest rates steady. Afterwards, you said that you and other experts continue to expect a meaningful amount of inflation due to Trump's tariffs. You said that it may take some time for the tariffs to work their way through the supply chain, but that you found, and I quote, many companies do expect to put some or all of the effect of tariffs through to the next person in the chain and ultimately to the consumer, quote, end quote. So while the president may try to claim other countries pay these tariffs, can you confirm that it is indeed consumers and businesses in the United States that will bear these costs?
So it can be anybody from the exporter, the importer, the retailer, the manufacturer, or the consumer that winds up paying these tariffs. In the beginning, it will be the importer that pays the tariff, but ultimately it will be spread out among those five, each of which will try very hard not to contribute. But in the end, the tariff will be paid. And all of the data suggests that at least some of that will fall, not all of it, but at least some of it will fall on consumers.
Well, you indicated it may take some time for tariffs to work their way through the supply chain. Would you elaborate on this, including when is it that we can see negative impacts to inflation from Trump's tariff policy?
So, the things that are being sold at retail now, they might have been put into inventory before the tariffs in February or March. So we think we should start to see this over the summer, in the June numbers and in the July numbers. And if we don't, I think we're learning here. If we see less pass through, there aren't historical experiences we can consult here, really. So it may turn out that the pass through is less or more than we think. And I think we're going to be learning. We'll get a number for June. An inflation number for June. We'll learn something then. We'll get it for July as we go through the summer. We should start seeing this. And if we don't, I think we're perfectly open to the idea that the pass-through will be less than we think. And if so, that'll matter for our policy.
Well, I've been talking with a lot of my constituents about these tariffs. And the question that comes up is now, is this going to only hurt maybe the big businesses? What about our small business people? What about the people that we buy goods and services from every day in our communities? Is this going to hurt big business as well as small business?
Yes, I mean, I don't think it's. I think it will certainly. If you're a smaller company that maybe imports a single product, that's a common business model these days. Then you may if your product is tariffed, you may be the one that's affected significantly. Whereas bigger companies have more resources and a more diverse product line.
Why do you think you can resist the president basically telling you what to do? What gives you that authority?
I don't think about it that way at all. I think I have a job that I'm sworn to do. And all I think of is how much people rely on us to get it right. It really matters that we get it right. And that concentrates one's mind. And so that's what we think about at the Fed. We think about what's the right thing. I have all I want to do in what's left of my time at the Fed is have the economy be strong and have inflation be under control, have a solid labor market. I want to turn it over to my successor in that condition. Of course, that's what it keeps me up at night, is to do that. And that's what I think about. That's the only thing I think about.
So how are you protected? By law, by constitution? Where does your authority come from?
I think, I've covered all that. I do think we're fully protected. And again, I don't think about that anymore. What I think about is let's just do our jobs. And that's what we do. We don't talk about those issues at all. And all we do is do our jobs as best we can. And, it's not an easy job, but it's one we've willingly taken on, and very important that we remain focused just on the job and not on other things.
Thank you very much. I yield back.
The gentlewoman yields back. The chair recognizes the gentleman from New York, our vice chair for communications, Mr. Lawler. You're recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, as recently as yesterday, Fed Governor Bowman indicated that if inflation pressures remain contained, the Fed should consider lowering rates, and said she is open to a rate cut in July. Governor Waller said very much the same. Do you believe that we are in a position where we may be able to cut rates in July?
So I would say this. I think if it turns out that inflation pressures do remain contained, then we will get to a place where we cut rates sooner rather than later. But I wouldn't want to point to a particular meeting. I don't think we need to be in any rush because the economy is still strong. The labor market is strong. If we were to see the labor market, meaningfully weaken in a way that was concerning, that would matter for that decision. But if we see inflation, continuing not to move up, we hadn't expected inflation to move up much. We do expect it to move in the summer. And if we see it not happening, we'll learn from that.
The September 2018 Teal book suggested that the Fed, seeing through tariffs' inflationary effects, is an appropriate response so long as inflation expectations are firmly anchored and that the pass-through costs are relatively short-lived. Would you agree that this assessment from the Teal book still applies to today?
I would. Those are the exact factors that we cite when we talk about this situation. Plus the size of the tariffs.
Right. So let's assess the current economic situation. The Monetary Policy Report states that longer run inflation expectations, quote, continue to be broadly consistent with 2% inflation, unquote. And a Harvard study argued that despite the relatively quick price responses to tariff announcements, the overall magnitude of these changes remains modest. So if these conditions hold, is it not unreasonable to think that underlying inflation trends should continue its path towards 2%?
That's certainly a very defensible position. I think what others on the committee think, and what I think, is that this is a question we need to be careful with because it's different than it was in 2018. The difference is that we haven't had 2% inflation. In 2018, we hadn't had an inflation as high as 2% for a decade anymore.
Right.
This is a different situation. We haven't fully restored price stability. And another shock, we have to be careful. If there's a meaningfully large and sustained inflation shock, we have to be careful about that. And so, I think we're just trying to be careful and cautious. And we really think that's the best thing we can do for the people that we serve. If that happens, we need to be there for it. And so, we're in a difficult situation in deciding exactly when to move. But again, if we continue to see inflation come in, not prove up at the higher levels than we expect, then that would matter for our decision making.
Chairman Powell, economist John Taylor once noted that the Federal Reserve should deviate from its own Taylor rule in the event of an oil shock, similar to the tariff scenario. A one-time price increase from an oil shock should not be accompanied with an increase in interest rates. Do you agree with that assessment?
I generally do, yes.
Previously, you said that if you wait for inflation to get back down to 2% to cut rates, you are already too late. You also said in November 2024 that inflation was on a sustainable path to 2%. Given that the FOMC believes that interest rates now are moderately restrictive and that an oil or tariff shock may not impact underlying inflation in a significant or meaningful way, because as the monetary policy report established, inflation expectations are firmly anchored, what is the reason not to cut rates?
Well, it's uncertainty about the size and potential persistence of the potential but highly uncertain inflation from tariffs. By the way, we have 5 Taylor rules in the monetary policy report. 4 of them say that the policy rate is in the right range, and the other one calls for a hike.
Right.
Just for the record.
Well, back in the beginning of the Biden administration, okay, when we talk about inflation, they increased federal spending by $2.5 trillion each year. $5 trillion in new spending. That's what gave us inflation, by printing all of this new money and borrowing. And yet you did not respond to that by raising rates. In fact, you were late to raise rates. And now again, we see a situation where you are late to cut rates. That is the challenge here.
Gentleman yields back. Chair recognizes the gentleman from Georgia, Mr. Scott, for 5 minutes.
Thank you, Chairman. Chairman Powell, to the best of your knowledge, has President Trump put forward a coherent tariff policy? Is that your opinion?
That is not a judgment for me to make or to discuss.
Well, what do you think?
Sir, it would be
you
I
running
don't comment on the
economy.
President's words or the President's
Does
policy.
the President, in your opinion, does he have a coherent tariff policy? You ought to have an opinion on that. You run our economy. This is your bailiwick. Do you think he's got a good policy? Answer me.
I would never comment on the President of the United States in that way.
All right. What do you think our policy should be?
We play no role in either establishing or commenting on tariff policy or fiscal policy for that matter. It's not our business. We have a specific mandate. We try to stick to it.
Let me tell you something, Chairman. In my state of Georgia, I got the fastest growing trade group down there. The Port of Savannah is indeed our nation's fastest growing party, and it's rising even more. The cost, the expenses, our business community is suffering. And I want to know what you think of our tariff policy. What do I tell my people? What do we tell the American people? And you're a good man. I want to know the answer to this question. I want to know how you feel. This whole tariff question, it's a tax increase. It's running people out of business. What do you think about that? Give me some sort of answer. Do you think anything about our tariff policy? Don't you feel you have a responsibility here? Are you afraid of President Donald Trump? Why don't you deal with this? Because our economy are suffering in a mighty bad way. And I've got to represent my constituency. And they are, let's take Georgia's agricultural sector, mostly pecans and poultry and cotton exports. They've been hit hard by retaliatory tariffs from key trading partners like China. Why are you running away from the tariff fight? Give us some understanding of that.
Honestly, this is just not our role. We are not a an institution that comments on or analyzes decisions that the president makes, or the things that he runs for office on and is elected on and then does. That's just completely out of our lane. It's really inappropriate for me to have any comment on that. I'm sorry to say, Mr. Scott.
We're having these regional disruptions. Our economy is in a bad way. And I want to see you and the president. You got to get together on this. We got pecans in Georgia. We got peanuts. We run the biggest group. We got the fastest growing trade mechanism in the Savannah Port Authority. We're crushed in Georgia. My business folks are coming to me on it. I got to get some answers from you. What do I tell them that the Fed chairman feels about their experience in this tariff? I think we need to get you and the president together.
Gentleman's time has expired. Appreciate the gentleman from Georgia. Gentlewoman from Florida, Ms. Salazar, is recognized for 5 minutes.
Hi, thank you very much for being here. Appreciate your time. And my name is Maria Salazar. I represent the city of Miami, which is one of the cities most composed of Hispanic Americans and people that adore living the American dream. So putting that into context, I wanted to ask you a few questions about the labor force. We agree with what the President Trump is doing, or what the administration is doing in deporting illegals, criminal illegals. We do not want Trender Agua. We don't really want people who have committed any type of crime, even more if they are illegals. And what's happening right now, after 6 months of being Mr. President being in office, that we're losing thousands and thousands of workers, what the ICE leadership has called collateral damage. And most of those people are working in three main sectors: construction, hospitality, and agriculture. Even the president said the other day in a tweet that he understands that those hands are needed. We're talking about 15% of the economy: construction, hospitality, and agriculture. So my question to you is, what is the growth effect on the economy if this type of removal of people, of hands being removed from those three main top sectors?
So immigration is another area where nobody put us in charge. We're not, Congressional Budget Office and other agencies can make assessments like that. We do have a role to maximize employment, but we take immigration policy we take it as it comes. What it's obviously done is it's really reduced the amount of growth in the labor force. And so at the same time, demand for workers has been coming down as well because they've been coming down at about
one drop at a time. Reduce the growth. Why don't we talk a little bit more? Because we want to continue growing. We're the number one economy in the world. We need to continue growing. So you're saying that what's affecting the growth?
Well, there are two things that affect growth. One is growth in the labor force, more people working, and the other thing is productivity. How much do they produce per hour worked? And when you significantly slow the growth of the labor force, you will slow the growth of the economy. But I think again, it's not for us to have a view on immigration policy.
No, I understand. I was just my comments, but you do agree that if we don't have those hands, then we don't grow.
I think that growth will slow and actually is slowing this year, and that's one of the reasons.
Well, we don't like that. So now let's talk about of the next 10 years, 2025 to 2035. Americans are not having enough kids. So that means that we need other people, right? So over the next decade, based on the current trends that I just explained to you and that you just reiterated, will there be enough workers to fulfill the labor needs of our economy between 2025 and 2035?
So I think labor economists do observe the phenomenon you're talking about, which is demand for labor going to be met by the domestic population, the native-born population? And the answer appears to be probably not over the next 10 years.
And then what about if we do not have that labor force over the next 10 years? What happens?
So many things will happen. You can see a big increase in productivity, which would mean we don't need as many workers. For example, artificial intelligence could be implemented in a way that creates widespread productivity gains. I wouldn't count on that, but it's a possibility.
You would not count on that?
I wouldn't count on it.
You would not?
No, I mean, I think there'll
not?
be gains because with productivity enhancing things, they typically take longer to be implemented. And then it takes a while for the gains to be shown. I think in the case of artificial intelligence, those gains are coming, but they may take longer or be less in the beginning than expected.
And during the time that those changes happen, then what happens? Our economy doesn't grow. Is that what you're saying?
Yes, but I mean, those who make immigration policy are entitled to weigh these factors. We
I
can
hear you.
report on what happens, but it's
know that.
really not our job.
I understand it's not. I just want to hear what you're thinking, what's your expertise based on those immigration laws that we're implementing right now. The last one, because I only have 30 seconds. Do you think that with everything that we have talked about, do you think that we can continue remaining, or the United States economy can continue being the number one economy in the world, and that we could compete if we were to have the immigration laws that we have right now?
I think you could have, the highest per capita earnings, but if you're talking about the aggregate output, then, population growth may be a constraint.
And which one of the two is more important?
Gentleman's time has expired.
Good question.
Well, I think
Gentlewoman's time has expired.
all right.
Let me turn
Thank
to
you,
the ranking member of the House Intelligence Committee, Mr. Himes, for 5 minutes.
Thank you, Mr. Chairman, and welcome, Chairman Powell. Let me start by thanking you for your careful keeping in your lane and steering clear of fiscal policy, and in particular for your stalwart defense of independent monetary policy. You're getting pressure from very powerful places and lots of kibitzing from lots of members on the interest rate question, and most know better that our independent monetary policy is the very bedrock of our economy. So thank you for that. Mr. Chairman, I want to talk just a little bit about some of the technical matters associated with energy prices and inflation, because obviously turmoil in the Middle East has sent oil prices swinging wildly, with West Texas Intermediate in the last month or so being anywhere between $61 and $75 a barrel. We recently saw the Iranian parliament vote to close the Strait of Hormuz, which currently handles around 20 million barrels a day, a fifth of global demand, and a little bit more in terms of natural gas. Chair Powell, you said last week that conflict in the Middle East in the 1970s resulted in very large inflation shocks. In contrast to the 1970s, today the United States does not import most of its energy. We call ourselves energy self-sufficient on a net basis. But I hear the argument made that I think is wrong, that because we're energy self-sufficient, somehow we are insulated from global energy market prices. Can you comment on that? Is there any validity to the notion that American consumers of energy are not subject to global swings in energy prices?
Yeah, so the price of oil is set globally, right? And I think if you go back a few years, the thought was that when the global, we had a natural shock absorber, which is that we would just drill more. And that we would, if prices went up, we would drill more. And so you wouldn't have these sustained price shocks that we had during the 1970s and the original OPEC era. I think that is actually in question now because, the oil industry in the U.S. is being much more careful and focused on return on investment than they were, having been burned with overcapacity.
Right. And I mean, yeah, in the long run, you can invest in additional extraction technologies, but this does not respond to day-to-day spot prices. So
not quickly.
The point I'm trying to make is that the conflict in the Middle East, if it resulted in $120 barrel oil, which is where oil was in 2022, that would have a fairly substantial inflationary impact on the American household. Is that correct?
We would certainly feel that, and as we discussed earlier, there's a lot of lore around looking through oil price shocks, but that depends on the facts and circumstances.
What, as a technical matter, we tend to refer to CPI, which is a basket of goods, and we measure the price changes. Roughly speaking, what percentage of that basket is comprised of energy?
I don't have that on the top of my head. It's much less than it was, of course. And oil consumption is much less than it was in the 70s as a percent of GDP.
But energy includes natural gas and gasoline, and it's a meaningful portion of the.
Yes, although of course we have more natural gas than we have so much natural gas, so that'll always be there for us.
So none of us can predict what's going to happen in the Middle East in an hour, much less in a week or a month or a year. But as a technical matter, at what price for a barrel of oil does the American household begin to feel inflationary effects? So we're at $75 a barrel roughly right now. At what price point does the American household begin to feel some inflationary effects?
I don't want to throw out a number. I think we're frankly, it's too early to say that something like that's going to happen. And I know that, but I wouldn't want to throw out a specific number. If prices went up materially, people would feel that.
Okay. Again, I think if I look at the data here, WTI per barrel, about 120, it peaked at about $120 in 2022. What do your models suggest would occur to inflation, and how would it influence the Fed's thinking should we be back at $120 a barrel?
Well, let's just say there's a big price spike in that range. So, we would look at that and we would ask ourselves, we look at the overall situation, we would ask ourselves, should we react to that? So, for example, during what we called the Arab Spring back in the early teens, oil prices went up a lot, and that went into the price, and then there was a discussion, and I think the right answer was to look through that. The question you'd be asking to yourself, because by the time you react, the price comes back down. I think the question today would be, is the situation different, and what would be the implications of those differences?
Gentleman's time has expired. I thank the gentleman from Connecticut. Chair recognizes the gentleman from North Carolina. Mr. Moore, you're recognized for 5 minutes.
Thank you, Mr. Chairman. Chairman Powell, I want to touch on international standard setting bodies like the Basel Committee on Banking Supervision. Their goal is to promote better harmonization for global capital flows and regulatory standards. But the Biden administration's implementation of Basel III endgame demonstrated the pitfalls when the U.S. is a follower instead of a leader in the international arena. That's why both Democrats and Republicans shot down former Vice Chair Michael Barr's proposal, which made capital less acceptable and put U.S. firms and businesses at a global disadvantage. Do you agree that the United States should only implement international standards in a way that is consistent with our own domestic legal and regulatory standards?
I do.
I appreciate the Federal Reserve's announcement yesterday to end the use of reputational risk during banking examinations. This supervisory practice was used as a tool to pressure banks to refrain from offering financial services to politically disfavored individuals or industries. What further steps is the Federal Reserve taking to help usher in these changes, such as ending examination practices that informally encourage banks to close certain accounts without written justification?
So we're developing, I should say, Vice Chair Bowman is developing a range of policies that will help in that area, and I should let her speak to it. But as you know, we've eliminated reputation risk largely in a thoughtful way from those things. I think we became more aware of that problem over the course of last year, and like the other agencies, decided to move away from that. We're very conscious of the fact that we shouldn't be telling banks who they can lend to, that's a decision for them in the private sector.
Let me ask you this, how are you ensuring though that like the frontline examiners are aligned with this new direction and not continuing with any past practices?
You know, I will say that is the ultimate question is will and I think they will. And I think as a former bank examiner, Vice Chair Bowman is actually very well positioned to engage with supervisors and in a way that someone with experience can do successfully. Whereas if you don't have that experience, I think it might be harder.
Thank you. You know, Secretary Bessent recently announced a drive to change the culture of supervision through improvements to examination procedures, enhanced monitoring of examiners' compliance with those procedures, and more realistic processes for appealing supervisory findings. That includes defining unsafe and unsound by rule using more objective measures rooted in financial risk. Do you support this initiative, and will we be seeing further rule changes at the Federal Reserve to achieve this goal?
So I like the sound of all that. I will say on issues of supervision, Vice Chair Bowman has, significant authority, and also she's got the background and the understanding. And the first thing I would do is I would ask her what she thinks about that.
Yeah. Just sort of a changing direction on a couple of questions. During the volatility in the Treasury markets last April, some have speculated that foreign investors were dumping Treasury securities. Since then, though, recent data has showed that foreign investors holding of U.S. Treasuries held close to a record high in April. Does this data show that Treasury's safe haven status and the dollar's global reserve currency status remained strong while the administration conducted trade negotiations?
I would say yes to that. I think we need to be careful about these narratives that pop up quickly. I mean, we're the world's reserve currency and the world's greatest democracy, and I think the dollar and is always going to be, for a long time, is going to be the reserve currency and the place where people want to be.
Let me ask you this. Do you believe there's a possibility that Treasury markets will crack just as Jamie Dimon has recently warned at the Reagan National Economic Forum?
I don't want to say things like that. I don't think that's something that's happening. Treasury markets are functioning well and normally, and they did function through a period of pretty substantial stress. And as you pointed out, Mr. Moore, that they're focusing well now.
Thank you. With that, I yield back. And actually, if Ms. Salazar is still here, I'll give her my remaining time. If not, I yield back.
Gentleman yields back. The chair recognizes Ms. Williams of Georgia. You're recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Chairman Powell, for being here. It's been a while since I've had the opportunity to ask questions sitting at the bottom of the room, but I am happy to have this conversation today because the last time we talked last July, I mentioned that combating economic inequality is a critical part of the Fed's dual mandate, and that is something that I am deeply, deeply interested in. Back then, we were talking about how we can get everyone in our economy to have the opportunity to contribute to their fullest potential, because that's how we get our economy firing on all cylinders and work to continue to close the racial wealth gap, which my home city of Atlanta continues to lead the nation in. That seems like such a far cry from where we are today, almost a year later. Forget our economy firing on all cylinders. Now our economy and our nation seem to just be on fire. We're looking at tariffs that are raising the prices of groceries, fuel, housing, and everyday goods. Chairman Powell, I get feedback every time I'm in a hearing about my nails because I like to get my nails done. And my nail tech told me about the increase in cost of so many of the different products that would be used just for me to get my manicure monthly, because tariffs are frightening so many of our small businesses, which we know are the backbone of our economy. And so it's hurting my community in Atlanta. But it doesn't seem like our president and my Republican colleagues are really interested in making sure that our economy fires on all on all cylinders, as long as billionaires continue to get richer, because that's what we've seen. And all of the the gutting that has been done to the federal government. And Chairman Powell, I'm sure that this is coming to your department as well. With the recent events that we've seen, we know that it is very dangerous to gut the federal government, agencies that we depend on, and politicizing the work of agencies such as yours. Chairman Powell, this current president has tried to reclassify tens of thousands of non-political public servants just to make it easier to fire them. And that includes people who have served in Democratic and Republican administrations. It even includes people who serve in independent agencies just like yours. Chair Powell, as a chair who our current and previous president routinely has threatened to fire, I think I just heard something on CNN today while you were here testifying. But what effect has this policy had on the career civil servants in your agency? And are these threats making it easier or I appreciate you doing your job, even when it might not be easy. It is important to tune out the things that you hear on the media, because I hear it every day representing a district that has a lot of federal employees, a lot of people who work at your agency. I hear from people all the time. Thank you so much. And not only do I have thousands of federal employees in my district, but my district has one of the widest racial wealth gaps in the country. Much of that has to do with our worsening housing crisis. And unfortunately, as we've seen with the past 6 months, this administration has been focused on this big billionaire bailout bill, gutting HUD, and releasing a budget that does not help the supply of fair and affordable housing nationwide. Now we've heard the president talk about having the power to control interest rates. In your opinion, Chairman Powell, what would you expect the effects would be on the housing market if the president were to lower interest rates without addressing the housing supply crisis nationwide?
Sorry, if he were to what?
If the president has talked about having the power to control interest rates. In your opinion, what would you expect the effects would be on the housing market if the president were to lower interest rates without addressing the housing supply crisis nationwide?
Honestly, it's not our job to speculate on things the president might do.
So what impact do interest rates have on housing access?
Over the long run, they don't really affect the housing supply. You know, assuming that rates will go up and down.
Well, not on the supply, but on the housing market. The supply is separate that we need to address going into this. If we're going to move interest rates up and down, that's not going to be the end all be all to getting people into housing. We must address the housing supply crisis. But what impact do interest rates have on the housing market in general?
Well, interest rates really affect housing demand. So with lower rates, you see more demand, and higher rates, maybe less demand.
Thank you, Chairman Powell. I am out of time, but I have lots of questions that I continue to work to close the racial wealth gap in this country, specifically focused on my district in Atlanta, where it is so prevalent. Thank you so much.
Gentlewoman.
Thank you, Mr. Chairman. And Chairman Powell, great to see you. And again, as I've mentioned to you before, always appreciate your steady hand at the wheel and not, I guess, getting out of your lane necessarily, but obviously you have a huge impact on the economy and what's happening there at the Fed. I want to kind of follow up a little bit on housing, as I've been hearing a lot about housing concerns in Northeast Indiana, and I know you're not you're used to being beat up on a lot by folks all around the country, but I want to speak specifically to one particular individual, Cardone Capital, Grant Cardone. He made some pretty strong remarks about your policy when it comes to the housing industry. And he said, that's why you have 500,000 more homes listed than buyers for those homes. When the rates come down, prices will also come down with it because you'll have more supply in the marketplace, and supply is what controls prices. He went on to say that, interest rates do not control prices. And he explained that lower rates could stimulate activity in the market, and activity is what makes the economy work. And I agree with his comments, overall, but I believe, as you said earlier, the economy seems stable. And I would agree with that coming from an ag and manufacturing area. It's not booming yet, but I believe most people are optimistic that the good times are coming and that the structure is set and in place. But when it comes to housing, it seems like that's where a lot of Americans they're stuck. You know, they've had low rates, they've got a good mortgage rate, but if they want to make a move, they have to go out of that 3% interest rate into, 4.5, 5 or higher percent interest rate. Thoughts on addressing housing, because their prices are up for sure, but there's no activity. The velocity is very slow. Would you like to comment on any of that?
Sure. So we see the same thing you do in the housing market. It's tough. There's not people are locked in. They can't afford to get out of their house because the cost of getting to a higher price mortgage would be a lot. So the best thing we can do though is to get inflation sustainably down to 2% and have it stay there over a long period of time. And that is really what we can offer to them. And I think, so if you go back to the beginning of the pandemic, when we cut to zero and we did all those programs, we really saved the housing industry because they're the front line for interest rates. At a time like this, when rates are, I would say modestly restrictive, not even moderately, but modestly restrictive, they feel it and their customers feel it. We understand that, but we only have one tool for the whole economy, not just for housing. So it's something we consider, but we have to consider the bigger picture. And I do think in the medium term, as rates come down, you'll see normalization in housing. Of course, there'll still be a national housing shortage. I don't know about your district, but
yeah. No, there's a shortage.
Yeah.
I mean, considering the macroeconomics of interest rates, I mean, how much consideration do you take housing into that decision as you address interest rates?
We're always briefed on it. We always talk about it. We always look at it. But at the end of the day, it's the big U.S. economy, the whole aggregate thing that matters.
Mm-hmm.
We also talk about the agricultural economy a lot as well. But ultimately, and manufacturing, it's got to be the whole, and not any one particular piece.
Yeah, I just would mention it is hard for American families to make that move, and they're stuck. And so I would just highly consider ask you to consider that piece of it, because when Americans can't move and Americans can't upgrade or move laterally, even it really keeps the economy kind of holds the economy back a bit. When Americans don't have that. But again, I want to say thank you, because you have a tough job, but I haven't heard from anyone in my district asking interest rates to go up. So I'll just pass that along from Indiana's 3rd district. So with that, Mr. Chairman, I'll yield back.
Gentleman yields back. The chair now recognizes gentlewoman from Colorado. Ms. Peterson is now recognized for 5 minutes.
Thank you, Mr. Chairman, and great to see you, Chair Powell. Thank you so much for being here today. I want to thank you for your long service to our country. I know that you've served under many Democrats, Republicans. You've always been nonpartisan and done your job to put our country first, and we appreciate your steadfast leadership. And if you are not reappointed, it will be very missed here. I have some concerns when I think about, I know you've touched on this a little bit through the questions today, but around the independence of the Federal Reserve. Your job, no matter what president you served under, Republican or Democrat, was to make sure that this was not a political position, while you brought news that some would not be happy about because it reflected what you had to do to address inflation. When I think about the conversations we've had going through the global pandemic and the economic fallout, and how we had to infuse money throughout our country to keep our services afloat, our businesses afloat. And while we suffered from inflation like the rest of the world, we had the quickest, strongest recovery. We were leading the globe. And so much of that was because of your leadership. And so when I think about what this position means, how important it is that there is independence, what are your biggest concerns about a
potential successor that doesn't prioritize that and wants to do what is politically asked of them versus what they need to do for the country? And what are their long-term repercussions if you're not acting on addressing the economic uncertainties and trying to address inflation in this position?
So I wouldn't speculate on that, but I would say, the credibility on the Fed on price stability is very, very important. People believe that we will bring inflation back down to 2% over time. And once if they really do believe it and it's true, then, that'll have big effects on not just short-term rates, but long-term rates. If that were to be called into question, then you'd see long-term rates go up. I mean, that credibility once lost is very expensive to regain is what the historical record says. So I just think I think people should understand that credibility on inflation is hard won and something we need to constantly tend. And, that's what we're doing with our current policy is just being careful with potential inflation risks. We haven't overreacted. In fact, we haven't reacted at all. But we're being a little bit careful about that set of questions as we decide what to do next.
And thank you for bringing that up. As we look at where we were, how far we had come in our economy, things were starting to stabilize, and we were starting to finally see a relief on the interest rates. They were starting to go down. Now they're holding steady. Can you talk about why the instability, when we look at tariffs around the increase in the deficit by the proposed big ugly bill that is being brought through Congress right now and increasing our debt by trillions of dollars and having our credit downgraded again because we are increasing our deficit. So with this economic uncertainty, where we were going, we were on the way down for reducing our rates, and now we have to hold steady to address the instability. Is that correct?
I'm sorry, could you just briefly restate your question there? I apologize.
Yes, I'm going to do this the best I can with with Sam here. That with our having to address inflation, as we've started to see it, you were able to decrease the rates. We were starting to go down a little bit. We were seeing that our economy was finally in a solid place. Prices were starting to go down. And now with the economic uncertainty, we're starting to see that you had to hold steady, whereas everyone was projecting before this administration came in with these changes that it was going to continue to go down. Can you talk about why you have had to choose to hold steady on the interest rates?
So we just, we stick to what we're assigned to do, which is maximum employment and price stability. We don't have opinions on fiscal policy or trade policy or immigration policy or any one of another or regulation policy, other than we have our regulatory responsibilities. And so we take what comes as it comes. And, elected politicians do what they do, and we don't criticize that. We don't have opinions.
The gentleman's time has expired, and the gentleladies.
Thank you, and thank you, Sam.
Chair now recognizes the gentlewoman from Texas, Mrs. De La Cruz, for 5 minutes.
Thank you so much. And thank you, Chair Powell, for being here with us today. I am Congresswoman Monica De La Cruz, and I am from deep South Texas, a largely Hispanic district, a rural community right there on the border of Texas and Mexico. I serve as the Vice Chair for Housing and Insurance Subcommittee, and it's difficult for families right now to afford a home on an average paycheck. I'm committed to finding affordable housing solutions for the people in my community, but also for all over the nation. So, Chair Powell, mortgage rates remain significantly elevated relative to Treasury yields, with spreads well above historical norms. To what extent does the Federal Reserve believe its balance sheet policy, particularly the runoff of MBS holdings, is contributing to this widening? And how does that factor into your broader assessment of financial conditions?
I don't think that our runoff of MBS is a particularly large contributor to that situation. I also think it's not just interest rates. It's so many things around housing now. It's insurance, it's materials, it's land acquisition, it's labor. There's so many cost pressures that are pushing up housing costs.
Thank you. With that being said, moving on to an entirely different topic, if the Federal Reserve focuses on issues outside its dual mandate, there are more opportunities for policy mistakes. How can you ensure that no other climate policy work is being done at the Federal Reserve?
So it is a big risk to our independence if we were to stray into areas where we shouldn't, that really aren't part of our mandate. And I would agree that climate is the biggest risk. So we really did the bare minimum. We did much less than I think people understand in the climate area. All we did was one piece of guidance, and then we ran one stress scenario. And by the way, didn't find anything. And I think you don't look to us to try to take on a bigger role or really to play any role in climate, which I personally think is an important issue and one that needs to be dealt with by elected officials. And for bank regulators just to step in and take that on without a mandate from Congress is not a good idea. It's not a good solution, and it's not a good way to remain independent.
Reclaiming my time, what kind of climate guidance did you make?
So for just the big banks, I believe,
ब्रह्मर्षि स्वामी सच्चिदानंद जी, श्रीमठ स्वामी शुभंगानंदा जी, स्वामी शारदानंद जी, सभी पूज्य संतगण, सरकार में मेरे साथी श्री जॉर्ज कुरियन जी, संसद में मेरे साथी श्री अडूर प्रकाश जी, अन्य सभी वरिष्ठ महानुभाव, देवी और सज्जनों, पिन्ने एंडे एल्ला प्रिय पेट मलयाली सहोदरी सहोदरन मार्को एंडे विनितमाय नमस्कारों। आज ये परिसर देश के इतिहास की एक अभूतपूर्व घटना को याद करने का साक्षी बन रहा है। एक ऐसी ऐतिहासिक घटना जिसने न केवल हमारे स्वतंत्रता आंदोलन को नई दिशा दी, बल्कि स्वतंत्रता के उद्देश्य को, आजाद भारत के सपने को ठोस मायने दिए। 100 साल पहले श्री नारायण गुरु और महात्मा गांधी की वो मुलाकात आज भी उतनी ही प्रेरक है, उतनी ही प्रासंगिक है। 100 साल पहले हुई वो मुलाकात सामाजिक समरसता के लिए, विकसित भारत के सामूहिक लक्ष्यों के लिए आज भी ऊर्जा के बड़े स्रोत की तरह है। इस ऐतिहासिक अवसर पर मैं श्री नारायण गुरु के चरणों में प्रणाम करता हूं। मैं गांधी जी को भी अपनी श्रद्धांजलि अर्पित करता हूं। भाई बहनों, श्री नारायण गुरु के आदर्श पूरी मानवता के लिए बहुत बड़ी पूंजी है। जो लोग देश और समाज की सेवा के संकल्प पर काम करते हैं, श्री नारायण गुरु उनके लिए प्रकाश स्तंभ की तरह है। आप सभी जानते हैं कि समाज के शोषित, पीड़ित, वंचित वर्ग से मेरा किस तरह का नाता है, और इसलिए आज भी मैं जब समाज के शोषित, वंचित वर्ग के लिए बड़े निर्णय लेता हूं तो मैं गुरुदेव को जरूर याद करता हूं। 100 साल पहले के वो सामाजिक हालत, सदियों की गुलामी के कारण आई विकृतियां, लोग उस दौर में उन बुराइयों के खिलाफ बोलने से डरते थे, लेकिन श्री नारायण गुरु ने विरोध की परवाह नहीं की। वो कठिनाइयों से नहीं डरे, क्योंकि उनका विश्वास समरसता और समानता में था। उनका विश्वास सत्य, सेवा और सौहार्द में था। यही प्रेरणा हमें सबका साथ, सबका विकास का रास्ता दिखाती है। यही विश्वास हमें उस भारत के निर्माण के लिए ताकत देता है जहां अंतिम पायदान पर खड़ा व्यक्ति हमारी पहली प्राथमिकता है। साथियों, शिवगिरी मठ से जुड़े लोग और संत जन भी जानते हैं कि श्री नारायण गुरु हैं और शिवगिरी मठ में मेरी कितनी अगाध आस्था रही है। मैं भाषा तो नहीं समझ पा रहा था, लेकिन पूज्य सच्चिदानंद जी जो बातें बता रहे थे वो पुरानी सारी बातें याद कर रहे थे। और मैं भी देख रहा था कि उन सब बातों पर आप बड़े भाव विभोर होकर के उसके साथ जुड़ जाते थे। और मेरा सौभाग्य है कि मठ के पूज्य संतों ने हमेशा मुझे अपना स्नेह दिया है। मुझे याद है 2013 में, तब तो मैं गुजरात में मुख्यमंत्री था, जब केदारनाथ में प्राकृतिक आपदा आई थी